All right, we are live now. Good evening, everyone. Good to see everyone once again. My name is Alex from MarketWise Asia. I hope you guys already had your dinner already. The time now is 7:58. We'll wait for a few more minutes to let the people to stream in. Okay, so if you guys can hear me loud and clear, please say a hi to me in the chat box. Today feels like doing a Facebook Live, but it's not. I'm not the speaker today. The speaker today, it is actually Terence from Impossible Investor. So once again, don't be shy. I won't bite you. I'm quite friendly. If you guys can hear me loud and clear, just say a hi to me in the comments, just to make sure that the sound check, the video, everything is good, everything is well. Okay, good evening, Hockley. Good evening, Joss, Chan. Okay, so right now, more people are streaming in already. Okay, so just a quick show of hand here, right? How many of you actually attended both the 2 days of the Market Insights Virtual Summit during the past weekend? If you attended both days, can be any sessions. You attended 2 days, right? Just type me in the comments. Type me in the comments. Just want to see a show of hand over here. And yeah, and how many of you actually also attended Terence session? Okay, he's the last speaker of the day. If you attended Terence session, right, type the letter T in the comments. Or if not attended any of the session, it is fine also. Okay, just type no. It is fine as well, okay? And today, Terence is going to share with you new stuff, new content also, okay? So right now, the time, it is already 8 p.m. already. So yeah, I think let's kickstart this session because I think it's evening time. I don't want to waste your time also, okay? Just let me do a very quick introduction of Terence here first, okay? So Terence started his career with a boutique fund as a trader. Okay, he went on to trade many different financial instruments such as forex, commodities, futures, CFD stocks before settling in finally as an option investor. And having over 17 years of experience in the financial markets, he has chosen to focus on the area of cash flow investing. And having built an investment community for more than 7 years running, now with an official trade record of 455 wins from 457 completed live trades with his community to date. And he has found a very simple and direct way to achieve repeated cash flow investing in only the best stocks that one can invest into. And today, okay, I hope you guys know that today is a options class, not a cooking class, okay? If you think it's a cooking class, then I think you're in the wrong room already, okay? So tonight, okay, he'll be sharing with you, okay, how to use options to hedge your portfolio against a market correction. Okay, I know that recently the market has not been doing well, and some of you are, stressing over the current interest rate, and you own a portfolio of stocks, you tend to hold long term, okay, but you don't want to sell them. So how do you hedge it using options? And options is one of the best way to hedge your portfolio. And or you want to short the market but have not figured out the best way to do it or the lowest risk to do it, and options can be one of the way to do that as well. So in this tonight 1.5 hour session with the Q&A, right, Terence, you look into the few option strategies, okay, that you can achieve with all this with the lowest risk possible, okay? Just some housekeeping rule also. If you are you wanted to ask any question, okay, please type your question in the Q&A tab, because some of the questions, if you put in the chat, we might not see it eventually. So please put your question in the Q&A tab. So without further ado, let's welcome Terence on board. Terence, do you mind if you just switch on your webcam and on your mic to say hi to everyone in this room over here?
All right, hello everybody. All right, welcome to another session with me and Alex.
Yes, can you guys hear Terence as well? If you can hear Terence, just type yes in the comments. Type yes in the comments. Can or not? Okay, fantastic. So everything is good. Okay. So yeah, I think today we have a lot of content to share with you from Terence. So I shall kickstart the session already. So Terence, all yours, man.
All right, thank you very much, Alex. Now, and today, all right, all of you really have to thank MarketWise Asia for arranging this special session, right, together with me to share more things with all of you. Right now, so I hope whatever I shared with you over the weekend session, right, was actually very, very useful and very, informational, right? But today, all right, we're going to cover a slightly different topic, right? And the reason I've chosen this particular topic is first, because it's very applicable to the current market situation, right? And number two, right, I really want to use this session, right, to be able to impart some knowledge, right, for all of you, right, for investing your precious time by being here today. Yeah, okay, now, so I'm going to take this from a format of how can you use options, right, which is my expertise over here, right, to protect your portfolio. Right now, if you're going to ask me, Terence, what if I don't have a portfolio? That is okay. Right? Why? Because if you also believe that the market, right, is about to break down, right, and you want to find a way to profit just in case the market crashes or the market severely corrects, right? How can you do so? Right? And how many different ways can you achieve this? All right, now, so let's get ourselves started, right? And anytime along the way, all right, if Alex has some, pinpointers, right, where all of you can learn more things, all right, he will actually come on, all right, and voice something for you as well. All right, now, so how are we going to do it? Okay, now, the first thing is, okay, if you have not met me before, right, there's only one thing, all right, I would say one thing, but it's interconnected, right? One thing that I choose to specialize in the last decade, right? And that's called options, right? Now, and I was thinking for a while because options is always inclusive of the stock market, right? Now, that's what I was trying to think, hey, is it one or is it two, right? But I still choose to say one because I trade a lot more options, right, than stocks itself, right? Now, so if you've heard me over the weekend, right, I'm going to cover a very, very similar one, right? Because today, right, our focus is still on this option called the put option, right? Now, so this is a product. Right, so think of put options, right, as a particular product, right, like something you'll find in a shop, right? Now, so if you can find something in a shop, right, we are looking at two parties that can be involved in this transaction, right? Now, the first party is called the buyer, right? So you have a customer, right, who will come into a shop, right, pay money, right, and buy a certain item, right? And this customer is usually the one that's also the most demanding, correct? They're the ones that will scream, they're the ones that will shout, all right? They are the ones that will demand whatever they want. Don't you agree? Right now, and usually, right, they get to decide whatever they want out of this thing, right now. And then on the opposite end, right, we have the seller, right now. So the seller is the business owner, the one who runs the shop, right now. What does the one who runs the shop do? Right, they only want to collect money. Agree? All right, now, so the first thing they get to do is to collect money, right? But like the weekend, I actually said this. Money never comes free. So if you accept this payment, if you take this money from your customer, right, you have to give the customer, right, some kind of promises, right? What are you going to give to the customer, right, to make them pay you, right? So this is the transaction that happens, right, in a put option, right? So the customer who's paying money, right, what is it that they actually want, right? Now, the customer who buys a put option, right, and pays that money, right, they actually want the right, or we call it the choice, right, to sell a stock. Right now, for those of you who are new with options, right, think of it this way, okay? Right now, this is a two-part question, right? Part one and part two. Okay, now, so let's look at part two first. Right now, if in your mind, right, you are seeing a stock right now, right, and your idea is to sell the stock. Right now, can all of you tell me, right, if you own a stock and you're thinking about selling it right now, where do you think the stock is going? Right, because you're thinking of selling it right now, right? Can you type it in the chat box and let me know quickly? Right, so if all of you are thinking of selling the stock at this very moment, right, you would do it because you think the stock is going. Oh man, looks like everybody's just finished the dinner. The blood is not flowing up to the head yet. Right, can all of you hear me? All right, if you can, all right, can I get you, all right, to just type the answers, all right, to the question that I've just asked. Thank you very much, James. All right, so James is the first one who's got his food digested. Cyrus, thank you. All right, now, so we are basically looking, all right, at the prices going down. All right, so because of that, all right, people are looking to buy put options. Yeah, so if anyone thinks that prices are going down, yeah, okay, and they want to make money from it, right, in whatever way, right? The idea is to actually pay and buy this put option, right? Now, so people who buy put options, right, they are actually expecting the stock to go down. Yeah, okay, now, so this is the same simplest basics over here. Now, so let's go to the company owner, right, or the business owner. So this is the one who collects that money, all right, okay, now, so this is also the person, all right, who oblige or promises, right, the customer this. So if the customer wants to sell, right, that means, right, as a business owner, your promise is actually to buy their stock, right? So to get paid to collect this money, right? Okay, you promise to buy the customer stock, right? But Terence, if I promise and I have to buy the stock, right? How can I make money as a seller, right? Now, the key thing over here is this promise that you're giving, right, may happen, right? Or it may not happen. So just like an insurance policy, right? The customer has to initiate the claim. So if the customer makes a claim, right, the company has to pay, right? Or the company has to accept the promise. Yeah, okay. But if the customer chooses to do nothing, right, this option will actually just lapse away and it will just disappear. Right. So the seller actually don't have to do anything at all. So potentially, right, the seller can actually make money, right, to do nothing at all. Right. So can you realize how similar this transaction is, right, when it comes to insurance? Right, it works exactly the same way. Right now, so for the put option seller, right, they actually just don't want the stock to go anywhere, right? Or if it goes up, that works fine for them as well. Yeah, okay, because the only time, right, that customers will make any claim at all, right, is when this happens, right, when the stock goes down. Right, so now, right, if you are thinking about hedging your portfolio, right, if you're thinking about protecting, right, your portfolio of stocks that you don't want to sell, right, Terence, I made a lot of money buying these stocks in the last 2 years, right, and I still think, right, that there is still some upside. All right, now I won't fault you for that, right, but today's session is to teach you how to protect these profits, right, in case, right, that disaster happen, right, so market will have the ebb and flow, right, okay, so we, to be honest, I'm seeing, right, a slow downward correction, right, but things may escalate, right, as long as there's a fear trigger, right, we may have that one downside move, right, that can happen very fast. So what we want to protect is really that, because when the downside move goes too fast, right, we may be looking at some big losses or severe losses in a very quick time frame. Right, so today I want to share with you 4 different ways of how you can execute this protection. Right, yes, today is not one. I'm going to share with you 4 golden tips over here. Right, okay, from the expensive one, right, to, right, the dynamic one, which is a budget one, right, and, right, ultimately a very professional one. Yeah, okay, now, so number 1, okay, we're going to talk about this format, right, like a car insurance policy. Right now, so I'm going to treat all of you like adults, okay? Right now, so if you ever transacted in a car before, or if you ever own a car, right, you know, right, that insurance is necessary, right? But insurance come in a couple of formats, right? You have the comprehensive insurance, you have the third-party insurance, right? And they protect different things. Yeah. Now, so let's talk about a comprehensive hedge, which forms as the comprehensive insurance. That means when you do this, right, you are trying to protect everything. Right? That means you don't even want to lose money at all. Yeah? Okay, all right, now. So that's why this is called the comprehensive hedge. Right? As long as the market goes down, you want to claim. Right now, you must understand, right? When it comes to a comprehensive insurance policy, right? The first question I want to ask is this: do you think it's going to be expensive or do you think it's going to be cheap? Right? Can all of you type your answer in the chat box? What do you think? Is it going to be expensive or cheap? Good. Right now, so can you see why I'm writing down this term? So if you think that you can afford an expensive hedge and you want to protect every single risk to your entire portfolio, then this is what you should be looking at. Right? Okay, you should be just outrightly looking at buying a put option. Yeah. Okay. All right. But I want to show you something more dynamic as well. Right? Because even buying a put option, you can do it in 2 ways. Yeah. Okay. Yes, you can actually do it in 2 ways. One, you can actually choose to buy a put option for the stock that you actually own, right? Because that will protect any downside risk on the stock, right? But then today, I'm looking at a portfolio, which means, right, in a portfolio, many of you may not own just one stock, right? You may actually own a basket of 10, 15, or maybe 20 stocks. So how can you effectively hedge, right, this entire exposure? Because if you buy a put option for each of these stocks, it's going to become very, very expensive, right? So although I'm teaching you comprehensive, right, but I still want to teach you how you can save, right, in a very dynamic way, right? Now, so if your basket of stocks is going to go down, right, what do you think, or what else do you think, right, will also go down, right? That means, okay, I'm trying to ask this, right? Your stocks will go down, right? But what situation, right, or what big product, right, will also follow suit, right? Can anybody drop a hint inside the chat box and let me know what you think? Thank you. All right, okay, EL, all right, welcome. You're here. All right, okay, now, so yes, the index. So if your portfolio is diversified, can you see that you can actually achieve a dynamic hedge, right, by buying a put option, right, on the index itself? All right, so if your portfolio is heavily technology related, right, then the index that you want to buy should be the QQQ. Why? Because you are a tech-driven portfolio. So you are not actually diversified in terms of business. You are diversified only in the tech sector. Does this make sense, everybody? Yeah, okay. But if you're telling me, Terence, I have stocks from all different industries, then, all right, the correct index that you should be buying a put option on is actually the S&P 500 or the SPY, right? So it all depends on how you build your portfolio, right? Okay, and I'm being very direct over here. Why? Because in the last 2 years, right, many of you, right, have steered and built a portfolio of stocks, right, for all the meme or all the hot growth tech stocks, right? So whether you like to admit it or not, I don't need to know, right? But I'm trying to show you how you can protect yourself today. That's my only aim today, right? So if your portfolio is heavily tech related, yeah, okay, then you should be looking at buying a QQQ put option, right? But if you're diversified, yeah, okay, then you can look at buying a SPY, all right, ETF put option. Yeah, okay, now, so doing it this way, all right, that's a good question, Kiki. Yeah, all right, we'll get to that as I go further, okay? All right, now, so this is the expensive one, right? So this is what we also call the rich person game, okay? Now, why do I say this is a rich person game? Right now, if we go and look at the markets right now, so I'm going to make it a very, very practical session, okay? Now, so if we go and look at the markets right now, okay, you are looking at the S&P charts. This is the SPY, all right? And you can see that the SPY is actually now potentially trading in what we call a downward channel. Yeah, okay, it just bounced up and it formed a lower high. All right, now, so this can be seen as a downward channel, all right? And the SPY, right, after falling the last few days, right, is actually right in the middle of this channel, right? Why is this significant? Because when it hits the middle, right, two things can happen, right? If it bounces from here, right, it can go all the way back to challenge the resistance. That's the first one. And that's what many of you will probably hope, right? But then if it breaks this middle line, right, we can actually see go all the way and hit the bottom again, right? And if you look at this, it's going to take some time, right? Now, so the next bottom can actually be somewhere around 4,000 level, right? If you look at 4,000 level, right, that's at least worth almost 400 points on the downside, right? And that's as good as almost 10%, right? So would this be a move that you actually want to protect, right, and actually want to hedge, right? So you see where I'm going now, right? But, okay, let's look at a comprehensive insurance first. So if you're looking to hedge your portfolio, right, okay, and let's say, right, you're thinking about hedging it for the next, until June, right? How about that, right? Okay, you're thinking about hedging this, right, all the way until June, which makes it about 65 days, yeah? Okay, now, so if you buy a full comprehensive hedge, so 438 is where the S&P is now. So if you buy a $438 put option, right, can you actually see how much it's going to cost, right? Just buying this one put option can cost you somewhere around $15.79, right? And when you trade options, right, when you trade options, everybody, right, it trades in 100 shares, multiples of 100. Right, so this trade is actually going to cost you $1,579, right? Okay, now, so to hedge, right, this is actually going to cost you $1,500, right? And if the market goes up, this money is gone, which means you're not going to claim on anything at all, right? It's potentially money that can go into the drain, right? So that's why you see I'm saying this is pretty expensive, right? Are all of you understanding and following? Right, okay, if you are, that's excellent. right? Okay, because, you know, unfortunately, I cannot go too much in depth, right, with the 1 hour kind of interval that we have over here. Yeah, okay, right now. So the simplest one is to just go out there, right, and buy yourself a put option, right? But it's not going to come cheap, right? So I'm going to give all of you a kind of like, you know, insight of how else you can do this, right now. So before I perform this, right, I want to ask all of you, right, another question, right? So today is going to be very much a question answer session, right? I want your engagement, right, because I want, right, to help you understand what I'm trying to teach you today, right? So the next one, right, is what I call and label the third-party hedge. Yeah, okay, all right. Now, third-party insurance, so we call it third-party hedge. So third-party insurance are usually cheaper, right, but they still protect, right, the most important damages. Yeah, okay, now, so what does this do and why should we think about doing this? Okay, my question to all of you now is this. Okay, now when you want to protect the downside, right, do you really want to protect the normal correction up and down of the market, or do you really only want to protect, right, the outright crash? Which one is it that you think is necessary to protect? Right, can you tell me your answer in the chat box? Number one, right, the ebb and flow, that means the normal correction of the market, right? Or number two, right, the outright crash that can potentially happen in this market. Which one do you want to protect? Good. So that's the one that's the most important, right? Right, because even when you trade, right, most of us have what we call this tolerance, right, for a little bit of losses, because we know trading involves risk. Yeah, okay, at least I hope all of you know this, right? Yeah, okay, trading involves risk, so, right? So all of you should be ready to stomach at least a little form of a loss, right? So when it comes to protection, right, don't go crazy, right, and try to protect every single thing, right? Because it's not very prudent. It's not a very smart idea, right? But something that's very effective, right, is gonna be buying a put option, right, on the same thing. Like I said, either the QQQ, right, or the SPY, right? But right, you will look to only buy, right, a put option with a delta of only 0.3. Okay, now of course, now we're getting a little bit technical, but not too much, right? Why? Because delta is something easy to understand, right? Delta for options is the same thing as like beta when we talk about stocks. Okay, now why? Because delta, right, is about 1, right? So the S&P 500, right, is that, you know, okay, sorry. For options, right, it's compared to the stock price movement, right? Apologies for that, right? Stock price movement, right? So what this means is, right, for every $1 drop, right, of the stock price, right, this option value, right, will go up by 30 cents, right? So for every $1 change, right, the option price will change by 30 cents. So it's just like a ratio over here, right? When you look at this delta, right? So why? Right, the question is, why, Terence, are you buying, right, only a 0.3 delta? Right, actually the answer or logic is very simple. Right, now, can all of you tell me, what is it that you're seeing on the screen right now? What am I drawing? Right, what is it that I'm drawing right now, everybody? Thank you very much. Right, I'm drawing the bell curve, or what we call the probability curve. Right now, so if this is the upside, right, this doesn't need any protection at all. Agreed? Right now, and this is what we call the tolerance zone, right? So this, right, we are willing not to protect as well, right? But what we really want to protect is this move, right? Anything from here and below. So can you see where I'm going now, right? And what does the probability really tell you, right? This is what we call the first standard deviation, right? Okay, and then this is the second standard deviation, right? So what's the percentage of results that will stay within the first standard deviation? Anybody remember your math class? All right, if I'm not wrong over here, it's around about what? 67%, right? 67%. All right, now, so by buying that 0.3 delta, right, I'm basically trying to buy a protection, right, that's somewhere here. Yeah, okay, can you see where I'm going? All right, I'm trying to buy a protection that's somewhere here, right, and anything lower. So if the market suddenly goes, right, out of the 1 standard deviation on the downside, right, my protection kicks in. Yeah, okay, that's why, right, I can pay something cheaper, right, but still achieve the hedge that I want. Right now, so let's go back to our trade earlier. right? And let's see how much can we actually bring down the cost now. Yeah. Now, so going into the platform, all right, you would have a delta column over here, right? And put options will always be on the right side. Okay. So the same expiry, June 17, right? The earlier one, the comprehensive hedge, is $1,579. Now let's look at a 0.3 delta. Right, so for the 0.3 delta, right, okay, we are going to be looking at 417. Yeah, okay, 417, and it will cost us, right, somewhere around $9.50. Right, $9.50. So can you see now, right, we have lessened the cost by almost $600. Yeah, okay, by almost $600. Right, now, would you agree that that is a good amount of savings that we achieved? Right, and yet we still have the necessary protection, right, of what we call the downside risk. Right, okay, all right, now, so this is a slightly cheaper form, right, of insurance policy, and we call this the third-party hedge. So you are buying a put option, right, with a 0.3 delta. Okay, I want to show you something. Why? Because if the market really starts to correct, that means when the market starts to hit down, right, this delta actually changes, because when the stock price, okay, or the SPY, right, is closer to the strike, right, can you see what happens to the delta number? It starts to increase. That means as the stock gets closer to the put option strike, right, the delta will actually go up. Why? Because the probability of winning is actually increased. So delta is a reflection of the probability of winning, right, for this particular put option. Right now, so right on the dot over here, 438, right, is round about a 50% mark. That's why you see 0.5. Yeah, okay, everybody, right? So if you want to buy a cheaper hedge for your entire portfolio, right, you can look at buying the SPY 0.3 delta. Okay, all right, now, so what's the third form over here? Right now, the third form that I want to teach you today, right, is what I call, right, the budget hedge. Yeah, okay, all right, I call this the budget hedge. That means, all right, like somebody asked me, Terence, what if I only have a $2,000 account? Number one, right, if you have a $2,000 account, that means you're not trying to hedge your portfolio. Okay, now, I apologize if I'm being too blunt, right, but you can't build any portfolio at all with $2,000, right? So I hope you see where I'm coming from. So the only reason you're trying to do this that I'm talking about right now, right, is you're trying to achieve an outright bet that the market is going to crash or the market is going to go down. Yeah, so you're simply betting, right, on the downside winner. If it goes down, right, you can make some money. Yeah, now, so for this, right, you may really want to look at the budget hedge. Why? Right, it's going to cost the cheapest, right, but at the same time, right, if it goes down, you can still make some decent profits. Right, and the way to do this, right, is a combination, right, of our third-party hedge. Why? Because again, right, you don't really want, right, to pay very expensive, right? But if the market crashes, you want to be able to benefit from that move, right? So what you want over here is to first buy, all right, a cheap enough protection, right? So a cheap enough put option, which is that 0.3 delta. Yeah, okay, all right, now, and okay, after that, okay, you want to make some money back. That means you want to bring down the cost. Okay, so what you can do is, right, further down from this put option, right, you can choose to sell a put option, right, with the same expiry date. That means both of these options will expire at the same time. Yeah, okay, now, so let's do this. Okay, our earlier hedge was 417, right, 417. Okay, now, so let's say if I go further down and you know, sell the 407. Okay, so this will make it, right, a $10 difference. A $10 difference on the SPY. Can all of you tell me in the chat box, right, in terms of SPX, which is the S&P 500, right, how many points is $10 worth? Right, how many points is $10 worth, everybody? All right, good, 100 points. Okay, now, so, pardon, right, is this sufficient enough? Yeah, okay, in terms of a difference between, right, the one side and the other side. To me, right, from experience, I'm telling you it is. Yeah, okay, I'm telling you it is. Yeah, okay, because if it breaks down, right, we are not exactly where the stock is now. We are about what, 438, right? So the stock would have to break through 417, which means it would have dropped by 210 points. Yeah, okay, now next line is another 100 points below, right? Like EL said, all right? So that means, all right, it will drop by another 100, which will make it a total of about 300 points. And that's pretty drastic. But that can happen. You realize what I said? All right, if the market goes in the downward channel just now, right, I did say if it goes and hits the bottom, right, how much are we looking at? 400 points. That's within the range. Can you see why this can actually play out? Yeah, okay, now, so if we look at this now, right, let's go and turn around and see how much, right, will this cost us? Yeah, okay, how much will this cost us? Right, so let's go to the broker's platform, right? We bought the 417, which will cost about $9.50. Right, so now let's go to the 407. All right, the 407, right, if we sell it, right, we can get about $7.40 for that. So now to pay for this particular combo, right, which is called a spread, okay, it will cost us only about $200, right, $200. Yeah, okay, now, so it will cost us $200 if it doesn't work out. That's okay, right? If you realize that's okay. But Terence, what if you're correct? How much can I actually make? Right now, the potential profit is actually 4 times bigger, right? It's around $800. Okay, why? All right, it's simply inside, right, the strategy itself. Okay, now, so over here, right, with this put option, we have the right to sell the stock. Okay, we have the right to sell the stock for $417. Yeah, okay, and with this sell put option, we have an obligation to buy the stock, right, for 407. Now, so I want to ask all of you a very simple question. If you buy a stock that costs 407 today, right, and you sell it away, right, at 417, right, how much profits, right, can you make at the end of this transaction? Right, can you type in the chat box and let me know how much profits are you looking at if you just made this transaction, right, that I've written out on the slides? Thank you, James. Right, so I can potentially make a net profit of $10, right, from, right, my right, versus my obligation, because I did both, right? I paid for this, right, and I also sold this away. So I have both of the rights and obligation, right, but at different prices. Yeah, okay, now, so I paid $2.11. Yeah, I paid, so this is a debit. I paid $2.11 to make a potential overall profit of $10. So can you tell me what's my real profit potential? $7.89. Agreed, everybody? Right, which is still almost close to 4 times, right, the capital I'm risking. Yeah, okay, so I think, right, that this is actually a very, very prudent way, especially, right, if you're trading on a very, very small account. Why? Because if you look at it, right, for this particular trade, I know, right, many of you always look from how much money you can make, right? But when you trade, right, let me tell you the biggest tip you can have, right? You can verify it with Alex later on, right? As a trader, right, the first objective, right, is to keep your capital. All right, I promise you that. Yeah, okay, when things do not happen your way, all right, the first thing you need to achieve, right, is to keep your capital. Right now, so if you do it this way, right, and we are wrong, how much can we lose? We can lose $211, right? Okay, but if I didn't do it, right, if I didn't do it this way, I only bought the 417, right? When I'm wrong, how much can I lose? I can lose almost close to $1,000. And if you're trading on a $2,000 account, right, losing $1,000, you just lost 50% of your capital. Number one, I know some of you will say, but Terence, I still have 50% left. I agree. But can you imagine, right, in one trade, you just lost half your capital, right? What will it do to your psychology, right? What will it do to your confidence? That's the bigger picture, right? But if I made a wrong trade, right, and I only lost, right, $200, now I only lost 10% of my account. I've still got 90% left, right? Can I still make that $200 loss back? I believe I can, right? And with that belief, right, it will still keep you trading. Yeah, and you will have the opportunity, right, to make it all back. But if that one bad trade, right, loses all your confidence, you're never going to come back, right? You're going to give up, right? And perhaps on just the crux of founding a very successful recipe, right? You never know, right? So that's the worst thing you can do to yourself. Yeah, okay, so always keep your capital protected. That's the first thing. Okay, all right, now, so how many of you, Kim, right, what you need to do over here is this. You will need to click on the third or fourth column, right? Click on it, and then you'll see a menu that allows you to change the details. Okay, Kim? Right, so click on the headline, all right, and then just change it to find delta, which is usually under options Greeks. Yeah. Okay, now, so I'm going to go through the is it the last one over here? Yes, the last one. Right, so I prepared one last one over here. Okay, it's going to become a little bit more professional. Yeah, okay, but if you can understand it, okay, you will like it very much. Okay, now, so this one, okay, I'm going to spend a bit more time on it. Okay, I call it the Reinsurance Hedge. Why? Like I said, it's a very professional protection, right? And who are the professionals? The insurance company, right? When it comes to insurance, they are the professionals. They sell, but they also protect themselves, right? And they're the most dynamic as well. Agreed? Right? So I call this the Reinsurance Hedge. So how is this done? Right now, the Reinsurance Hedge works like this, right? You want protection. So go out there and buy yourself a protection, right? And, right, here comes my question. When you buy a protection, right, does it make more sense to buy a longer expiry protection or to buy a shorter expiry protection? Which one works better? Right, which protection will work better? All right, can you just type longer or shorter? Right, ignoring the cost first, okay? Good. So the longer it is, the better. Agreed? Why? Because nobody knows exactly when this market is going to collapse. So if I'm given more time, right, there becomes more chances of it happening. Agreed? Yeah, but there is a downside. And the downside is this, right? When I buy a longer protection, right, will the cost increase or will the cost decrease? Right? Can you type your answer in the chat box now? All right, will the cost go up or will the cost go down? Yes. So you know, you can't have the best of both worlds. Can you see now? Right? You can't have the best of both worlds. But with this that I'm designing right now, I can. All right, I can. And I'm telling you, I can. All right, why? Because I can go out there, I can spend this money to buy that long-dated put option protection. Right? But after buying, right, because I don't expect the market to crash and burn in the next 30 days. What can I do now? Right? I can get some money for the next 30 days. How, Terence? Right? I can sell the same put option, right? Exactly the same put option, but only with a 30-day expiry. Can you see now? Right? Because, right, if the strikes are the same, it doesn't matter. Right? Because when this stock goes down, right, my option, right, is the same line. Right? The only thing difference is the time duration. Can you see now? Yeah, okay. But when I do this, because I have a sell component, right, I will be able to collect money. Right? And this money that I collect can help me offset, right, the cost of buying the protection. Yeah, so this strategy is called the calendar spread. So you can do this if you don't see any potential at all of the market crash and burning in the next 30 days. Right? I'm telling you, it's very possible. Why? All right, number one, right? The Fed just raised interest rates. They just started. Right? So do you really see that the market will just roll over and die now after 10 years, right? On the first sign of this? No, nobody's afraid yet. Right? On the second raise, maybe still nobody's afraid, a little more, but not everybody. Right? Maybe when we hit into the third and the fourth interest rate raise, interest rate hike, then people will start to panic a little bit. Yeah, okay, but I still think we are in the initial phase. There's an outlier chance that the market may do so, right? But this strategy will still protect me. Here's the good part. Yeah, okay, I only end up making less profits. Yeah, okay, all right. But okay, if it doesn't work out, right, I just lessen my cost and still keep the protection. Right? So this is what I like about it. Right? So let me show you now on the platform. right? How do we achieve this? Now, so if I think, right, going to the chart, right, that the line that I really want to protect over here, right, let's say, right, is this. Let's go to about what, 410. Let's take 410 right now. So what I can do now is I can go all the way out, right, and let's say about, let's do 3 months, right, July 15, right? So let's do July 15, right? I'm giving the market 3 months, right, to collapse, right? So I'm going to buy a 410 put option, right? So buy a 410 put option, okay, right? And now, right, I'm going to go back, okay, and sell that 30 days, right? So by selling that 30 days, right, we can look at it now, blah, 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 blah. All right, so let's look at a May expiry, about 37 days. All right, so I open this up, I'll go to 410 as well. Right, and can you see? Look, everybody, right, how much can I get for selling this 410 put option? I can get almost $4.40. Now, tell me your calculations, right? Okay, and I'll tell you, if all of you are good in, you're gonna be successful, right? If you start a business, all right? Now, so for 3 months, right, I get paid, right? For 3 months, right, I have to pay $10.77, right? But now for 1 month, somebody is willing to pay me, right, $4, right, and 40 cents. Okay, $4.40. Yeah, okay, now, and right, when this expires, right, can I do this a second time? Right, can I sell, right, this put option a second time? Can all of you tell me, yes or no? Okay, so this will be what, 90 days, right? So if I just sold 30 days, right, when this is gone, can I sell another 30 days after that? Yes, I can. Can you see now? Because this one has not expired. So in theory, I can sell this put option, right, 3 times over. 3 times over, right? And if each time I collect $4.40, even if the market doesn't want to collapse, right, can I still end up making money or not lose anything on this trade? All right, can you tell me yes or no? Have you seen it yet? All right, if you haven't seen it, all right, let's talk about it. $4.40 plus a next set of $4.40, right? Plus, right, a third set of $4.40. Right now, is this more than the $10.70 that I'm paying upfront right now? Yes, I am. All right, so let's say the second round falls a little bit short. Let's say $3, right? And then Terence, the third round falls a little bit short as well, $3. You can only get 3, you can't get 4. That's okay, right? 440 plus 3, right? Plus another 3, how much do I have? 10. Can you see now? 10. Yeah, all right, so what's the harm then? Yeah, now James, right? This is where I say it becomes professional, right? Why? Because now if I'm selling the May expiry, it has 37 days. So the market is telling me, right, a 30 days put option at 410 strike is worth about 440, right? So moving forward 30 days, if I look for another put option that expires in 30 days and the stock never changed, it's the same stock, assuming that the price didn't move, it's still here. So if I look for another 30 days put option at 410, how much can I expect the option to cost? Similar, don't you agree? All right? Similar, it's the same, all right? Or round about that range over there. Yeah, okay. So can you see, when I design this, right, I'm buying a 90 days put option. I've got 90 days for the stock market to get me that crash. I think it's decent enough, right? If it doesn't happen, it's probably not going to happen at all. Yeah, okay. But, right, by doing this reinsurance way or the calendar spread, right, even if I'm not right, even if I'm wrong, right, I have a chance of constantly offsetting, right, how much I'm paying over here. All right, look, come May 20th, if the market stays here, this put option, right, is going to expire, right? It's going to be gone. It's going to expire, right? And then, right, I will go back, right, and look for the next 30 days expiry, right, which is going to be this June 17, right? June 17, right? So by then, it won't have 60 days anymore, right? It will have only 30 days left or 35 days, right? So can you see? So a 30 days option with the stock, the same place, right? 410. All right, it's still going to cost me about the same amount. That's what I'm trying to tell you, right? So if I sell that for the June, right, I still have, right, my July, right, 410 puts, right? Okay, but I have the June now where I collected another $4. So I collected 440. If I collect a second 440, can you see, right? This hedge for the next 2 months left literally cost me nothing, right? It literally cost me nothing. Yeah, and if it does start going down, right, I will start getting my profits. Yeah, okay, all right. Now, so right, yeah, right. So when I sell the second put option, right, it's still considered as a calendar spread, because a calendar spread, right, is different actions. You have one buy, you have one sell, right? But the only thing different between the two options is the expiry date. So can you see I didn't change the put option? It's still going to be 410, right? All I did was the expiry date. I bought the very long one, which is July 15. Yeah, okay, and I sold, right, the shorter expiry ones, which is this. The first one is going to be May 20th, right? So can you see this initial trade is only going to cost me $6.30. So when I set this hedge up, right, to start, right, this hedge is only going to cost me $635. Yeah, okay, I have the potential to keep decreasing the potential loss, right, as we go further into this trade. And if I'm not correct, right? But Terence, what if you're correct? You're going to start making your profits. It's just a matter of how much of these profits, right, you can reap out of the market, right? So let me give you the different scenarios and the different outcomes, right? So let's go back to our slides of it. So in this reinsurance hedge, right, the benefits work this way. When you have, when you are wrong, right, you end up making very small or potentially no losses at all. Yeah, okay, now, but when you are, the loss minimization possibilities are there, right, based on what I just told you. You can sell a second set, you can even sell a third set, right, to keep offsetting, right, the purchase price. Yeah, right now, but when you are right, okay, you can start making profits. Okay, if it happens too soon, right, you will still get a little profit. Right, there's still a little profit available, right? But if it happens, right at the sell put option expiry, right? So our first sell put option is 20th of May, right? So if the market goes down, right, all the way to 410, okay, so from 438 today, right, it goes all the way to 410, right? And it did it right on the dot on the 20th of May, right? I have a question I want to ask all of you, right? Today is the last day, right, of the May 410 put option, right? So if the market goes all the way down, okay, let's not make it 410, let's make it 411, right? 411, and the option is going to expire today, right? How much is the May put option going to cost? Can my customer make any claims? The line is here, 410, but the stock is at 411. Can my customer make any claims, right, in this scenario for this put option? No, right, Grace? Right now, so they can't make any claims because it didn't collapse below the line. So if there are no claims, that means this is worth zero. You know, obviously, this is worth nothing, right? But that's not all. Why? Because I still have, right, what? The 50. I got too excited there, right? I still got a 15 July 410 put option that I bought at the start of the trade. And when the stock goes down from 438 to 410, right? And this put option still has 60 days left, right? How much do you think this put option is going to cost now? Will the price go up or will the price go down from when we started? Thank you, EL. Right? It will go up, and it will go up a lot. Why? Because I bought this put option, ladies and gentlemen. When you buy put option, you want the stock price to go down. Can you see where we're going now? Right? You want the stock price to go down. Yeah? Okay, now I'm going to show you how do I say this? I need all of you to think abstract over here, right? So if you can see it, all right, congratulations, right? But if you can't, right, unfortunately in this session, I cannot go into those details, okay? Right, but this is what I want to help you see, right? So let's go over here, right? So assuming, right, if the stock, right, which is SPY, really drops to 411, right? So from 438 to 411, right? Can all of you tell me, right? Can all of you tell me how much, right, did the stock go down by? What's the total amount that the stock went down by from 438 to 411? $27. Thank you very much. All right, okay, that's good math over there. 27. Right now. So would you agree? Would you agree? Right? If I simulate this trade now, right? If I simulate this trade, so let's go to our July expiry. Right? So this is our July expiry. Right now. So what we did initially was the 410 put option. Right? So from 438 to 410, this is the amount of distance. Right? But now, assuming that the stock really dropped, that means the distance between my stop and the put option is now closer. Do you agree? Right? It's now closer, right? Yeah. Now, so if I move the strike by $17, right, it will give me the same effect. Right? Okay. Now, so if I move the strike to 420, right, now it will show me that this put option, right, would have moved up, right, by at least $2 more. Can you see? Right? 410 is about 1070. Yeah, okay, all right. 420 is about 320 over here. Sorry, 1320. Yeah, so it will go up by $2 and more. Right, so that's about the potential profit, right, I can be looking at. Yeah, okay, right. There may be more, there may be less, because there's a lot of dynamics that will go into this. Right, this is a little bit more of advanced option trading strategies. Yeah, okay, but right, when you learn something like that, right, you can actually perform very, very dynamic hedges. All right, and the best part, they don't cost a lot of money. Right now, so the bigger profit can happen, right, if the stock drops right on the death, right, of the sell put option expiry. And the last one, right, your biggest profit will be achieved, right, if the sell put option has expired, right, and before you start selling the second set, right, the market crashes. Why will you achieve the biggest profit? Because, right, you only have a buy put option. You haven't added the second sell put option, right? So you have your naked put, you have your buy put option protection. If the market crashes, right, you make everything. Yeah, okay, you make everything. So that's the biggest profit you can achieve, right, out of this dynamics over here. Okay, ladies and gentlemen. Yeah, all right. Now, so before I go to the next component, right now, Alex, right, are you still in the background over here, Alex?
Yes, I'm around.
Right, any questions you want to throw up?
Okay, so let me take a look at the, by the way, if you guys want to ask any question along the way, you can ask in the Q&A tab. Okay, so there are a few questions. I think, you know, a lot of people are asking about this calendar spread. It's kind of getting confusing for some, but it is fine. It is fine. Okay, let's move on to, okay, let's take a look at number one question. The first one by James Liu. Okay, what if we sell a put expecting price to rise, but it fall instead? He wanted to sell a premium, okay? But we don't want to own the stock now. Is it wise to roll the put option? Under what situation will you consider rolling the put options?
First, James, right, you realize that this question doesn't apply to the portfolio hedge that we're talking about today.
This outright want to profit from the...
Yes.
Yes.
Correct. All right. Because when you're asking, hey, Terence, you know, if I sell a put option and you want it to rise, I agree with that. Right. So when it falls, right, and you don't want to own the stock, right? So your typical question is this, right? You probably have to do something with the option. One, right? You close it now, but you'll probably have to lose money. You have to take a loss. Yeah. Okay. Or two, right? You can close it, right, and start selling a new expiry, right? Which is the role you're talking about. But before you do that, right, one thing I always teach my students, right, is this. What's your reason? What's your justification? Because when you trade options, you are not running away from the stock, right? So the thing you need to ask before continuing this trade is the same as a stock. If you own the stock right now, will you consider holding the stock, and take the paper losses, or right, you have got enough. I don't think it's going to go back. All right, this is the loss. That's it. All right, I don't want to continue. All right, because if your answer is I will sell the stock right now, then you should not continue the trade. That's it. Right? But if you look at the stock and you say, Terence, I think it's going to bounce, so I'm willing to hold on to the stock, then by all means, go ahead and continue it. Right? So that's always how I look at the trade, right? And justify every actions I take. Right? You don't make a decision just because you feel like it. Right? You have to make decisions based on the reasons and the evidence that the stock market is trying to give you or tell you. Right? Because when you can do it that way, right? One thing you achieve is you have very consistent decision-making process. You become very systematic, right? You're not like, oh, today I feel like this, tomorrow I feel like that, right? And your results will reflect, right, how you decide. Yeah. So if your decision process is consistent, right, your system, right, is going to produce those consistent outcomes, right? So of course, if it's not working out, then it's not going to work out consistently, right? But if it's working out, right, then it will. So look for your reasons, right? The reasons are the most important thing. All right, Alex, let's go to the next one.
Okay, so I think you answered Kiki already. How do you utilize the option strategy if the account's only 2K? You can't really hedge your portfolio, which is 2K. I think Terence already answered that already. I think another question, by Leon is that what would be the option expiry date? I think a lot of people have difficulty choosing, the strike price and also the expiry date. Is it 1 month, 2 months? So do you have any simple tips or any ideas how should they choose their expiry date?
First, right? Okay, it stems from the idea of how long do you think it will take for this market to have the chance of crashing? Yeah, okay, so if you think that's going to happen within the next 1 month, then 1 month is enough, right? But if you're not very sure, then, give it an extra month, right? Of course, if you can afford it, right? But if, you think that 2 months is not enough, right? Then, right, before you go further, you must ask yourself this important question: can I afford the hedge? Yeah, okay, why? Because, right, let's look at the dynamics. 1 month, right? May 20th. Okay, now, so let's say, all right, we do the initial one, right? For, what was it? All right, 30 delta, all right? So let's make 422. So if I buy this, right, and then I sell the 412, okay, this is going to cost me $195 for 1 month. Yeah, okay, what if I want 2 months, Terence? Go to June. Yeah, okay, let's look at 30. Where's 30? All right, so the first one is 195. Right now, so if I go 2 months, right, I buy this 417, right, and 407. This one is going to cost me a little bit more, right? So this will cost about 211. So 195 versus 211, right? How much is it more? $14, right? But what do you get in extra? You get 30 days extra time. So do your comparison, right? Is it worth $14? If it's me, of course it's worth $14, right? 30 days of time. Yeah. So can you see it makes sense? Yeah, okay, it makes sense. So once you realize either you cannot afford it, right, or it doesn't make sense anymore, then it's time to stop. Don't go further. Don't stretch it further than that. Yeah. Okay, so back to the rational decision-making process. Yeah. Okay.
Okay, so I think when it comes to hedging the portfolio, some people, if you think that the market is going to crash, like what Terence said, you buy for 1 month, you think it's going to crash in the second month, buy for 60 days, right? Some people might asking, what happens if it doesn't crash within the next 60 days? Do they need to buy more in the future, or what should they do?
I like that question. Why?
Do they want to keep buying their put options until the market crash? That it could be 1 year, 2 years, 3 years later. That kind.
Correct. I like that question. You know why, Alex? Because what's the topic today? How to hedge your portfolio. Yeah. So if the market refuses to go down, are you still making money actually? Yes, because you're owning stocks. Correct? So what's the idea of protection? The idea of protection is paying to protect. But your eventual portfolio, if the market goes higher, is still going to make money. Yeah, but it's protecting your fear on the downside.
Yeah, so I think there are people asking, what if the market doesn't crash and all this, right? So you must treat this as a insurance. Your insurance, you are just paying for protection. You are not paying for, as in you're not buying the options to profit from the market. Just
Yes.
like buying insurance, you're buying a term insurance, hopefully you don't need to use the insurance, you see. Yeah, so
Yes.
it's the same as this kind of hedging portfolio using by utilizing buying a put options. Okay.
Yes.
Yep.
And Alex, actually, I got a very, very good suggestion from them.
Yeah.
Because I'm not very good at market timing. I make mistakes because I'm an option seller. But I heard you are the charting god. So they should,
no, I'm not.
They should attend your Facebook Live on Friday when you say the market is going to crash. Then they should start executing this.
To be honest, I have no idea when the market is going to crash. But if you really own substantial amount of stocks, a portfolio, and you want to protect yourself against a catastrophic crash, I think it is wise you have to buy some options to protect your whole portfolio if you want to hold your stocks for the long term. But for me, I'm more like doing swing trading, and if I really do options, I mainly sell options for profits, not for hedging. Yeah. I think there's something more interesting coming up, right? Now that the hedging is protected already, how do you actually profit from the stock market?
Right now, actually, it was this. If you start, if you're also a regular attendee of Alex's Facebook Live session on Fridays, right, which is very coincidentally after mine.
Yeah.
Right?
Okay. I think one good question. I think Jason Lee, can I hedge my existing stock options position? You are hedging the stock options. Can or not?
Can. Why? Because if you are a buyer of call options, if you see where I'm going now, that means you're bullish. That means your entire portfolio of option trades are bullish in nature. Then buying this hedge, right, will protect the downside, right? But then you also have to decide, right, is it worth executing this protection? Because buying call options usually already have limited loss scenarios. Yeah. Okay. So, if the losses are not extensive, if the losses are not huge, then, there's nothing that you really want to protect. Right. So you have to think about, of the amount at risk if the market collapses before you execute, this portfolio protection. Right? Otherwise, then it's just pretty much a downside bet. Yeah, okay, so probably like the spread that I mentioned earlier, right? A cheap downside bet, all right, will still allow you to capture some good profits, right? If you really, want to aim for the downside.
Okay, I think there's another question, Derek, but I think it's asking about selling for premium also. Okay, what if SPY drop below 410 within the first month? The sell put will be losing money. Will the sell put be losing money?
Good question. Right now, you must understand the dynamics of this professional hedge. Right? Why? Because in this hedge, I have both the sell and the buy. Right now, so I'm hoping I'm not getting too technical, right? Okay, but right, options have what we call this intrinsic value, right? So if we look at it, let's say the market crashes, right? We have the 474. His example was 410, right? Okay.
Yes.
So we have 410, and both the buy and the sell is 410. So let's say the stock goes to 407. Yeah. Okay. Now, so this sell put option, I'm obligated to buy the stock, right, at 410. Okay. And now the stock is only worth 407. Right. So how much am I looking at? Right. So you're right. You are looking at a loss of $3. Do you agree? All right. But don't forget this. This buy put option, right, which is longer expiry, right, gives you the right to sell the stock at 410. So this will have the same $3 priced in to this buy put option, right? And yet, remember, options are more expensive, right, when they have a longer date, right? That means the longer the option, the more expensive they are. Why? Because of time value. So ultimately, right, can you see that this buy put option, because it expires later, right, will still have a higher value than this one that you're selling because it's shorter dated, right? So this is where, it gets a little bit more technical. It's a little bit more advanced because you have to, put into the time frame, the dynamics of options, the dynamics of options pricing. Yeah, okay, all right. But I just really want to put it out there today, right, so that all of you have an idea, right, of how, great kind of dynamic options can be when you start to understand the different strategies available. Yeah.
All right. So thank you for the answer. I think that's about it for the question in the Q&A so far. If you have any more questions, okay, do keep them coming in. I think meanwhile, Terence can proceed with your presentation.
Right, great. Now, so I was actually really putting Alex on the spot just now, but actually what I wanted to say was this. Right? After the joke, it was really this. If you start hearing Alex, right, raising the risk alert of the market, right, that means, right, there is a potential, risk in the market, right, then maybe that's like a signal where you can think, hey, should I execute a hedge for my portfolio or not? Yeah, but most importantly, like Alex raised up, right, a portfolio hedge is a hedge. It's not a profiting trade, it's a hedge. So it's a form of protection just in case it really collapses. But if it doesn't, right, then it's okay because you own stocks and that means the stock will continue to go up, right? And you're still going to profit from the stocks. Yeah. Okay. Now, so since you're here with me, all right, now that you've learned how to protect your portfolios, okay, I want to remind all of you that do not forget over on the weekend, right? All of you have actually learned, right, how you can actually create some explosive profits, right? So let's talk about those profits again. Right? So if you have already embarked on it, congratulations, thank you very much. But for many of you who are still considering, right? Okay, don't forget about the 24-hour revenge earnings options. Why? Because like someone said today, all right, let me see who was the gentleman. All right, James, right? Okay, James, I'm not sure if you're in for the next season or not, right? But when we trade earnings season, right, if you remember about earnings explosion options, which I talked about last Sunday, yeah, okay, I won't go into details today because there's not enough time. Okay, so you can rewatch the replay, right, if you want to find out more or if you missed the session, right? But in that session itself, right, we will teach you how to accurately observe, right, when big players are getting into a stock the day before earnings. That means you are spotting abnormal movements, right, a day before the event happens, right? And once we spot that move, right, what are the criteria? I'll be teaching you. Yeah, okay, once you spot that move, right, we will adopt our sell options, right, with low capital requirements. Right, so some of you say, Terence, how can I do this, right, with a portfolio of only $2,000, right? You can't really perform any hedge. Why? Like I said, honestly, you probably won't be owning a lot of stocks to begin. So if your portfolio is small, right, you have to trade it, right? You have to take a little bit of risk, right? Okay, that's stomachable, right? And then try to make and grow your portfolio bigger, right? Or your $2,000 trading account bigger, right? Okay, so this is definitely a good idea if you're wishing to embark. Yeah, okay. Now, if we are wrong, all right, sorry, our capital requirement can be as little as $100 for one option we're trading, right? And if you follow my methodologies, there is no stock ownership required at all, right? Pretty much like what I showed you today, right? If you do it right, all you need to do is to close the option trade, right? There is no need to own any stocks in the process of this. Yeah, right now. So what's the next best part? We make sure that every trade I get into, right, has what we call a defined risk. I know exactly what's the worst case scenario, right? If I'm happy with it, I can accept the loss, then only will I move ahead and place the order, right? So I'll teach all of you this as well, right? So we can actually control the loss to less than $100 when we're wrong, right? So that's very good for those of you who are starting out, especially small accounts, right? Or those of you who have been looking for, right, trading strategies that allows you to have small losses, right? Even when you make mistakes. Right? Because the focus, right, is really about the winners. Yeah. And lastly, right, how do you choose the right strike prices, right, to sell, right, is actually the key. Right. And I saw some questions as well in the Q&A box. Terence, how do you choose the strike price? Right? That comes from experience, that comes from trading, that also comes from understanding, right, the stock that you're looking at. Right. So inside this mentorship program, right, you will be learning, right, how we aim and how do we choose, right, the ideal strike prices for the options we trade. Yeah. Okay. Now, so for those of you who have not met me before, all right, I'm Terence. All right, I'm Terence Tan, or I'm Possible Terence. Yeah. Okay. I trade the stock market, and I'm an experienced option trader, or more importantly, seller. Yeah. Okay. For the last decade and longer now. Yeah. So I'm the creator of the 24-hour earnings explosion, right, and also a very important cash flow strategy, where I sell put options, right, on some of the best companies out there, right, for recurring income opportunities. Yeah, okay. In fact, right, we do Facebook Lives on Friday, just like Alex, right? I said earlier, my sessions are earlier than Alex over here, just before his, right? So I'm also a mentor to over more than 1,000 investors, right, who are trading week to week with me right now, right? So without further ado, I just want to close things up, right? We are offering all of you the 24-hour earnings revenge options, which is trading the earnings season, which is upcoming in 2 weeks from now, right? Together with, right, what if the earnings trade go wrong, Terence? Right? Can I still recover those losses? Yes, you can. but you need to know how to execute the revenge combo, right? So I will be including it, all right, inside this mentorship program, right? So the earning season for Q2, right, is not one strategy, right, but it's a combination of two trading strategies, right? So you can think of it, right, as what you have learned today, right? I make a trade, right, or I own some stocks, but Terence, I'm scared of the losses. Then how do I protect that? Instead of doing a hedge today, like I mentioned, you have to pay for it, right? You can perform the revenge combo, right? That's my trading strategies, right? I'm very risk adverse. Yeah, okay, if you like it, great. I like making profits. Who doesn't, right? But I make sure I always end up protecting myself first. Like I said, the key is to keep your capital. When you can achieve that, then go and think about how much money you can make, right? So if you're interested in something like that, right, our boot camps, right, are actually going to start this Saturday, right? That's why this is your final window of opportunity. Yeah, okay, by tomorrow, we are closing the whole intake, right? Why? Because it takes 1 or 2 days to set up. Yeah, okay, so we're going to close it latest by tomorrow, right? So if you're still undecided, all right, make sure you get in right now. Okay, the boot camp is going to happen on 16th of April, Saturday, right? A full day from 9 in the morning to 4 p.m. Right? As part of this mentorship, all of you will get 10 live trading sessions with me, right? And our live trading sessions will start on the 25th of April, right? So the dates will be given to you once you have successfully registered, right? We will be holding 6 trading sessions together with 4 market opening profit-taking sessions, right? So that's my commitment to you, right? So we're going to start trading at the crux of the earnings season, right? Which is starting on the 25th of April, right? As you can see on the dates, right? There are more than 200 companies, right, scheduled to announce their earnings day by day over here, right? So without dragging you further, right, this is the entire package, right, which includes, right, an online course access, right, once you sign up today, right, and then the 1-day bootcamp webinar, right, the 10 live trading sessions, right, all the trades that I'll be executing during the upcoming earnings season, which lasts for up to 6 weeks, plus, right, all the revenge trade, right, that we will be taking, right, on any losses that we'll be making, right? So everything will be told to you, right? How much to open the trade, how much to close it for, is there any revenge that is needed, right? What should we do, right? Everything is told to you, right? And in fact, you can watch all the sessions over and over again for the next quarter, right? So recording replays are made available for you, right? So what's in it for you, right? Or how much it's going to cost you, right? We have some remaining slots that are still open from the weekend, right? So we're going to offer them up today, right? And once it's gone, right, unfortunately, we're going to close the doors as well. So there's 2 deadlines, either by tomorrow or when these final slots run out, right, from tonight's session, right? So we have about 15 slots left, right? So please make sure you grab them, right? So these all, right, are made available for you at a price of only 497 Singapore dollars. Yeah, okay, so the link is over here, right? bit.ly/24 revenge. Okay, there's only one R, 24 revenge, right? Alex has also put the link right inside the chat box itself, right? So please go ahead and click on it. Yeah, okay, and right, there is still the surprise available. Yeah, okay, all right. So wait for my team's welcome email, right? And all of you will find the surprise package or the surprise gift, right, inside the email itself, right? Which is also worth $497, right? So please get in right now, right? This is the final window. Okay, so the data over here, right, together with, right, the cost of this mentorship program, right? If you look at it this way, 497 Singapore dollars, right, to learn one full strategy, right, and trading it live with the mentor who created the entire strategy, right? There's no better offer that you can get out there over here, right? So I hope you benefited from my sharing today, right? And I look forward for you to benefit more, right? If you decided, hey, I like options, Terence, I want to trade with you in the upcoming earnings season and learn more, right? So I warmly welcome you, right? I look forward to seeing you as well, right? If you're part of this program, right? Alex, over to you again.
All right, I think there are some questions regarding the 24R. So maybe we can answer that straight away first. Okay, first of all, Tommy is asking in the chat box, is it in USD? No, this is in Sing dollars. So it's 497 Singapore dollars. And KM Fong is asking, right, is this membership for a year? Maybe Terence will answer this
No,
question.
this mentorship program is a very dedicated mentorship program to only trade the 24R revenge strategy. Right, so this, right, will last for the 6 weeks, right, of the Q2 upcoming earnings season. Yeah, right. So this will last a 6 weeks mentorship program, right, for the entire Q2 earnings season.
All right, so basically, the trade live session 1, 2, 3, 4, 5, 6 plus the 4 market opening profit taking sessions, total 10 sessions. Okay, right? And then Aline is asking, what is the minimum account size to take part in the live trading?
Right, minimum account funding you're looking at is really $1,000 US. Right now, that's of course not the recommended. Recommended will be anything $2,000 and more, right? But if you really want to stretch it, right, we do have students who trade the season with that minimum of 1,000. Yeah.
Okay, so what is the difference between 24R and 24 Revenge?
It's just like an upgraded version because we used to trade the earnings season, right? And then I discovered, right, as much as I'm okay with it, but we do have a lot of participants who are new to trading, right? They are very, very, adverse against, trades that lose their money, right? So I upgraded it, I made it better, right? So now we're back with the 24-hour Revenge, right? And I've decided to include it without raising the cost at all. All right, so you're all getting a much better, mentorship experience, right? Without the fear of the losses that may be involved in trading. Yeah, okay, trading this particular strategy, right, in this upcoming quarter.
All right, so basically this is an upgraded version. You still get more, but you're still getting 497 only. And Tommy, yes, I know in SG, HM in USD. What do you mean by the word HM?
I would believe that he's probably asking about the trading, right? So yes, we are trading the US market. So your accounts will be funded in US dollars.
Yeah. Yes, definitely, yeah. Okay, so be it Tasty Trade or TD Ameritrade, it'll be in USD, all right? Okay, so okay, Jason is asking any discount for those who took 24R previously.
So Alex, get him to contact my team. So I put the email inside the chat box as well. Right. So send my team, all right, the email to let them know you're, one of the past graduates, all right, and speak to them. All right, they'll help you on that.
Okay. So KM phone, that means the recording digital portal also expire in 6 weeks.
Yeah, we'll make it available for at least the next quarter. That means until the start of the next earnings season.
Okay, so let me take a look at the Q&A tab once again. All right. Kim is asking, right, how to join the Facebook Live on Friday. Maybe you want to post your group on the
there we go
chat box.
Right here. Yeah. All right. So you can go to Facebook, all right, and just type in the search box options for cash flow, right? And you'll probably see our Facebook group over here.
Let me try to search for it. Options for cash flow.
Can't find it, Alex?
Yep, I can find. Let me post the link in the comments. Just give me 1 second. 1 second. Okay. Yep, I already posted the link. So if you want to join Terence on his Facebook Live, I posted the link in the chat box already. Okay. Simon and CK is asking very specific on the brokerage account platform, which option company should we open the account with? What's the different commission rate for Tasty World and TD Ameritrade? Maybe you want to, Terence, give a very quick answer on that.
Okay, I will go with these 2 guidelines of it. Number 1, if you already have a trading account, then it doesn't matter whether it's TD Ameritrade or Tasty Works. Doesn't matter. But if you don't even have an account yet at this moment, and if you have never traded options before, 0 experience, right, the brokerage that you need to choose is Tasty Works. Yeah, okay, all right. So if you don't want any trade, clearance restrictions or problems after opening an account to make trades, Tasty Works is your choice. Right, so ignore the commissions because all of them are very competitive. Right, it's neck for neck. Yeah, okay. Commissions are no longer affected.
The same price. Okay.
Yes.
Yeah.
Right. So now the ease of trading and being able to trade after you open the account, right, and follow during the earnings season, right? Tasty Works is your choice.
Ace is asking, right, can trade using mobile if not available during the live session? What happens if I miss the session due to work?
Yes. So both our brokers have their trading app available, right? Okay. We have prepared the videos or the video guides for order placement on the app platform, right? So you just need to make sure that you watch the videos so you know how to click the buttons, yeah, okay, to place the orders, and yes, it can be done.
All right. So Jace is asking again, what kind of return can we expect and how sustainable would that be?
Okay, now, so as you see over here, as per the title, right, this is an earnings trade formula, right? So anytime there's an earnings season, which is 4 times every year, right, which lasts for about 6 weeks each time, right, you can keep executing your strategy. Why? Because the big boys, when they identify a play, right, they are right 80% of the time, right? It took me 5 years, right, to be very, very sure about this back test, right? I can tell you they're right 80% of the time, right? And they will keep playing this game. Yeah, they will not stop playing it. So once you learn the strategy, once you learn it well, all the criteria is involved, you can keep using it as long as you want. Yeah, all right. Okay, so don't worry about the lasting sustainability of the strategy. It's going to keep working as long as earnings is around.
All right. So I think, to be honest, as I mentioned during Sunday, 6 live session plus another 4 live session of the profit taking, Terence is taking a whole lot of time doing live trading with you guys. And to be very honest, 497 is really, really value for money. Okay. Value for money is a good term for it. If I really say, I would say it's really dirt cheap. Okay. Yeah. So 497, you get to trade live with Terence, see how he trade. I think that is very valuable. And as I can mention, not many trainers or educator or trader will actually trade live with you. Not many will do that. Okay. So any more question? Before we call it end of the day. Okay. Just type in the chat box and also can put in the Q&A tab, whatever it is. Any other question? Okay. By the way, any last word from Terence as well?
I think really just like Alex said over here, right? The reason why we actually engage all of you is we understand, right? Many of you have looked at options, right? But many of you are also, in a place where, hey, Terence, I really want to get started, right? Okay, now, is this a good place to start? And if you look at the, commitment I'm giving in this mentorship program, like Alex is saying, I'm handing you one entire trading strategy. And like I described earlier, right, it's going to keep lasting, right? That means it will keep lasting in the stock market because earnings will never disappear, right? Earnings announcement will never disappear. So being able to master a strategy that you can keep using for a long time, right? And together with my time and commitment, trading the sessions with you, up to 10 of them, right? To make sure that you learn it well. On top of that, even sending out to you all the trades that I'll be executing over the 6 weeks of all the earnings. Yeah, okay. Let's not take away the fact at 497 over here, right? It's really a bargain, right? So if any of you are really serious about picking up a new skill, a new trading strategy, right? Don't miss out on this. Yeah, right. Really try not to miss out on this. I'm looking forward, right? Because it's going to kickstart this weekend itself.
Okay, so JS is asking, right, to open account with Tastywood, do we have to take the knowledge assessment test as required by MAS?
To be honest, I opened my account 10 years ago. So
yeah, I also actually forgot already. I opened quite some time from TD Ameritrade. I forgotten whether I need to take the assessment test. But anyway,
if I'm not wrong, I think there isn't a need to because they're based in America. So
based on my experience, I think I don't think you need. Even if you need, I think the tests are pretty simple. It's not that difficult. Okay. If you're already trading the market, you should be able to answer those questions. All right. So Tommy is asking, can I join from the Philippines? Of course you can. So this is online, this is on a webinar base. You can join from anywhere around the world as long as you can open the account, Tastyworks or TD Ameritrade or from the US brokerages. That is fine. And Kim is asking in the Q&A tab, right, can we use this strategy for day-to-day options trading?
For this that you're learning is very specific to, how do I say this? It's very specific to earnings season. All right. Okay. So you will be able to use it. All right. 4 times every year. Right. But for the revenge trade combo concept, right, it is actually potentially possible to apply it to a day-to-day options trading. Right. So it's pretty much a split part component. Yeah. All right. But the focus is really on the earnings season over here.
All right. I think I don't see any more question in the Q&A tab. Oh yeah. Okay. Talking about the is the Bring a Buddy still available?
Damn, you broke my gift. I told you the gift will come in the email. Yes, Alex is still available. All right. Okay, still available. So anybody who signs up today, all right, that promise still goes out.
Okay, so I suppose, Sam, you attended during the Sunday session, right? Because if you didn't attend, I don't think you know this promo, right? Yes, so yes, you can bring a buddy at 497. So essentially, it is one for one buffet. So at 497, okay, for the price, just for the two, okay? Yeah, 497 for the price for you can bring two people to come inside, okay?
Just register yourself today, right? Okay, and then wait for my contact from my team, right? Okay, for the next bonus. Yeah.
Yeah. So once you registered, make the payment. Don't be too anxious. Wait for Terence team to get in touch with you. They ask you who you want to bring along to for the session. Okay. All right. Any other question? Okay. So I think if there's no more question, I think thank you, Terence, for your sharings once again. And I think, today's is talking about hedging the portfolio, protection. Okay. I hope you guys, can take away one key idea or one key strategy, whatever it is, you can explore on your own also. Once the downside is protected, you can look for the opportunity to profit from the options market by using this 24-hour trade alongside with Terence. So downside protected, is time to make profit. So I urge you guys to also join this session with Terence. Once again, to recap, 6 live trading session and also the 4 market opening profit taking session with Terence. Total 10 live session, and also the this coming Saturday bootcamp, and we still have left about 15 slots left, right? Or until all the rest is taken.
Offer. Yes.
Yep. So once again, I will just post the link, okay, one last time before we call it a day. All right. So yeah, there you go in the chat box already. Okay. If I do not have another buddy, can I have another gift? Just go and get a friend lah. There's no more other gift ready lah. I mean that you can share with your friends, ask your friend, okay. Anyway, this buddy is just another bonus, okay. If you do not have any friend to bring along, it is fine as well. I think this is really a very good bargain from Terence already, okay. So yeah, that's all for today. So once again, thank you, Terence, and I see you guys in his sessions, okay, for the live trading sessions.
All right, thank you, Alex. All right, thanks.
All right, so yeah, good night.晚安. Have a good rest ahead. All right, thank you. Bye-bye.
Bye.